Hey, what's happening all? It is Friday the 22nd. Another month is blasting freaking by. I can't keep up with what's happening. I would have been doing this from the mountains because my daughter and I got deer tags this year. A couple of weeks ago, went and checked it out to see what it looked like, and everything changed in that unit. We used to be able to get access to a lot of the landscape there and be able to find, there's certain spots I liked hunting because the deer were coming in and out of it. Now there's a lot of closures. Private land has been sold. People put up no trespassing signs. Only one spot that I could go to that I used to be able to find deer at, and I saw zero tracks. And it's probably because of all the population change out there. So I went ahead and turned my tags in, get my points back for the later draw, and we're going to go to Texas and shoot something else. But so since I'm in town, I'm not hunting. I figured I'd get together, have Mr. Scotty Bear and David Bennett get on the line with us again. You've seen both these guys before. You heard them before. We got data that they can drop on you and hopefully be helpful for what's coming in the future. How you guys doing?
We're good.
Doing great. Thanks for having me.
Well, I appreciate you being willing to jump on because I don't give you guys a lot of heads up. It's like, hey, what's happening? You ready to jump on a Zoom call? I got some shit we got to talk about. So I figured I would. I appreciate you being willing to do it. That you guys shower in the morning, are ready to jump into video. People notice a different hat. Scotty, I didn't plan it. He bought this for me a while back. I thought I'm gonna ask Scotty to jump on today, and I'm gonna show some respect and show the hat. And he happened to be wearing the same dang thing. Dave's missing out. We're gonna have to buy him one.
I might say I'm not going to do another video until I can sport the hat with you guys.
Well, we're gonna have something coming. Have to get something out to you. So what I'm curious about, and the reason I brought you on, Dave, is I'm curious about what's going on in the mortgage-backed securities market. Any data you've got, I throw stuff out as far as news that I see, but I'm going to throw some of the coupons up here. You got charts all the way from the 2.0 to the 4.0, and I'm wanting to kind of dive into this a little bit deeper for folks to understand what we're looking at and why we're looking at it. Now, I use it to see where the market's trending and whether or not we're going to see rates move. And what's interesting, I've been going off the 3.0 and the 3.5 quite a bit, and I've noticed they've held fairly steady, but the 2.0 has been taking a beating. How long has it been since the 2.0 has been a real player in our owner-occupied deals?
It's probably at about 60 days ago, we started moving away from the 2 into the more into the 2.5 for the owner-occupied deals. And
okay,
rates are certainly moving up. That's the consistent trend. The timing of this video is good. I was actually in San Diego earlier this week at the Mortgage Banker Association conference. There were several thousand mortgage bankers that converged on San Diego to meet and talk. And the consensus is that rates are going higher. There's some differentiation between how much higher. Some people are projecting that it goes, but most everyone was projecting that it's going to continue the trend that you've seen over the last couple months.
Yeah, we can see here with the the charts here back in August, and as it started to trend downward, the security itself therefore pushing the interest rates up. They go exact opposite. So you said it's a couple of months ago that the 2.0 was kind of taken out of favor. So that's back in here in August, and we started to see that downward trend. And so at what point is it when you break par, or when you're approaching par, that you guys really start to, and par meaning 100, that you start seeing a reason to break away and go? Or is that why things get pushed into a different coupon? I'm curious about being able to explain that to folks.
Yeah, I think most borrowers would want to be able to do essentially a no-cost mortgage or a low-cost mortgage, and so they need some premium in the rate that they end up locking with when they buy their homes.
Okay. So that's where you start getting into where there's premium above par, and that's where you start using different coupons. And so interesting thing here, if we're getting pushed into 2.5, there's always going to be a margin between the owner occupied and the investment property. So we would be looking more at the 3.5, usually about a 1% difference in coupon, correct?
Yeah, and you'll notice that the trend on the 30-year is, more flat. I'm sorry, on the 3.5 coupon, and the reason for that is as the rates on the lower coupon have moved up, suddenly the prepay risk for those higher coupons is not as high, and there's more appetite for those coupons, and so the the 3.5 coupon, when everyone was doing 2s and 2.5, was artificially lower priced because of that prepay risk. Meaning investors don't want to invest in a mortgage that they're hoping to have around for several years and then to get paid off in just a few months because people refinance into a lower coupon.
Makes sense. And so ultimately, and that puts pressure, and we may be seeing right now, we are looking at 3.5, seeing, interest rates, depending upon the situation, depending upon many factors, could be high 3s, maybe low 4s, and probably even pushing more low 4s these days. And I think we're probably very soon be looking at the 4.0 as our benchmark for, or at least the coupon for our investor loans, correct?
Correct. And right now you see that those coupons have been flat-ish. If the projections are true, what the mortgage bankers are saying, what Fannie and Freddie are saying, Chase, Wells Fargo, those are going to start trending down as well.
Okay. Well, and right now they're attracting more capital, and like I tell everybody, it's supply and demand. Rates are no different. The more the supply, the better the option to get it. And supply is shrinking in the 2% and the 2.5, and gaining ground in the 3% and the 4.0. So, or 3.5 and the 4.0. And that being the case, there's more available to borrow. Therefore, a little more consistency, and that's why I think we're going to start, and therefore why you're going to start seeing your owner occupieds moving those higher coupons. Correct?
Yep, you're right.
Very cool. So, and then with that, Scotty brought you aboard here because you've been seeing a lot of questions about rates. In fact, you probably get more questions about rates in a day than anybody that I know of, just because you happen to be in the seat that people are asking questions of. And so curious here, what are you seeing? What is the biggest thing that people are asking about, or people wanting to do here, that's actually been most detrimental to them?
Everyone wants a lock, new construction, rehab. Everyone wants a lock today because rates are awesome, and everyone hears that potentially rates are going up, and locking prematurely too early can actually get you the worst rate possible. If something's not going to be complete, I know with the builders and everything, their intentions are, they tell you your house is going to be ready on a particular date. But if you're locking too early on a 45 or 60 day, and it pushes out and actually takes 90 days, you're not beating the market by locking early. When it comes time to reprice or extend your lock, it potentially comes with a premium that makes it possibly worse than what we're seeing in the current market at that time. So beneficial just to wait and lock when it's time to lock, when you have your appraisal done, certificate of occupancy. You're not going to beat the system by locking early.
And that's why we've always said and encouraged people is like, when it comes time to lock us, when you start knowing that we can order the appraisal, the property's pretty much done. What's amazing is we've heard a lot of folks in different parts of the country talking about, what it takes to get a certificate of occupancy. And many times they're saying it's only a few days. Well, we're seeing it take weeks now, where property's done, appraisal's done. All we need is a certificate of occupancy to fund, and all of a sudden weeks go by. So we got to be cognizant of those things, because there is frustration expressed to us about, the cost to keep that lockup, and we need to do something about it. Nothing we can do, guys, but give you the best advice we can and let you be the CEO of your real estate investment business. You tell us what you want done. We'll advise the best we can, but the end result's going to be your decision and on you. That's unfortunately how that goes. And that's the stakes of being the boss, right? Calling the shots. So Dave, interesting thing here. Scotty's talking about you lock and expires. It can cost more. When you're locking in, you're really not getting any money pulled out of the market. It's not like that is the capital set aside for you. What's really going on there when we have a lock, in quotes, basically?
Yeah, when we lock a loan, we're essentially committing to buying that loan, right? So in order to protect ourselves from potential interest rate movement during the time, at the same time we are selling a mortgage-backed security, and that's how we hedge. That way, if rates get worse or better, either way we're protected. But there's a cost to both of those, and a steeper cost as time goes on. And so, we don't, time doesn't freeze for us. Prices don't freeze for us at the time you lock. And so if you lock and you need an extension or even a relock, it increases the cost to just piggyback on the point that Scotty was making.
So ultimately, when you do that, when you commit, and we're committing to being able to give somebody a certain rate for a certain amount of money, we're locking in this amount, right? And we're committing to that, but the market's moving on us. So we're hoping that the market gets better, gives us at least a better position when we actually close on that commitment. But we're also creating another security of the exact same amount and sending it out to the market, getting somebody to buy that from us to commit to them. So if it goes up or down in the other direction, it really kind of puts us apart, evens it out.
Right.
Yep. And we send that out, that commitment for a certain time frame, and then we have our block commitment for a time frame. And that time frame changes. Now you have an expense that comes about. Right now, somebody's got to pay something, and we do the best we can to keep that expense down for our clients. But there comes a point where everybody else has to honor their end of the deal too. And when they don't, for some reason, people think that this is an expense the lender has to take on. Lenders, guys, there's only a certain amount of money we got coming in to be able to make these things work. And we're cutting margins low as hell to stay competitive in the market. And for some reason, there's this belief that there's a stupid amount of money being made, which is not necessarily the case. In fact, sometimes there's a stupid amount of money being spent because of the volatility of the markets. And the one thing that I want to really get out to everybody, rates are going to go up. We have been blessed with something that's a complete anomaly. And the rates going up right now, even cracking into the fours, man, before COVID, people would have, can't imagine the shit that they would do and the dances that they would have done to be able to get the rates we're offering today. Take COVID out of the mess. Take the federal government dumping trillions of dollars into the mortgage-backed securities market completely out and put it all back on the market. When we're looking at what's going on today, is still the best rates I've seen in my career if you take out that anomaly that came with COVID and with the Fed dumping money into the market. Would you say the same, Dave?
Oh, absolutely. Yeah. I mean, from an historical perspective, rates are incredibly low today. It's just we all have short memories and think, oh, well, 6 months ago, they were a little bit lower. But no, rates are incredibly low. And money is very cheap. It's a great time to be investing.
Extremely cheap.
I tell many when I have a God knows how many rate calls every day. And I tell people when I call you, if I was calling you and told you, hey, today par rate 5%, today rate 6% on an investor loan, people should be very excited for 5-6%. They've just been so spoiled. We all have with like you said, historic lows.
Yeah.
And the other thing people like to do is they like to call and find out what the rate is before they even find a property, before they even get ready to go. So they want to know what to factor in. And unfortunately, they've been treated like consumers so much that they're acting like consumers, spending a lot of time deciding, I'm going to get in when the rate is the right price. You don't go buy gas when it's the right price. You buy gas when the damn tank is low, right? So, and I don't know how very many people who look at their half a tank, drive by the gas station, head home, and the next morning it's like, man, we got to drive around today. I better go get gas. Pull up to the gas station, see that, wait a minute, it was $3.10 yesterday, walk in screaming at the guy because it's $3.12 now, right? That moves so rapidly. I've watched it as I'm sitting at a light. I watch it change with those digital pricing. I've seen it move. So this is no different. This is something moving with the market, just like fuel is, just like any other commodity, just like any other security. The one thing I want to continue to drive home to people over and over again, I'm going to bitch till I can't breathe anymore, that it doesn't matter what it is, especially when we're living in an environment when inflation is higher than the interest rate. Look at what we're talking about today. I'm showing right here. You go to John Williams Shadow Stats, shadowstats.com. We've talked about it a lot. You go to their alternate data tab, scroll down and click on inflation. And if you scroll in, you'll find this particular chart. This chart shows the CPI and what the Fed is claiming interest that the inflation is based upon their metrics and how they pad their index. There's certain things that are not included on that. They have substitution processes that they use. Then John Williams adds back everything in. It's just following specific things all the time. And you can see he's showing that's 13%. It's actually more than 13%. We're showing over 5, like 5.6 or something percent right in here that the CPI is claiming, nearly 13 or over 13 based upon what John Williams is claiming. Somewhere in there is our real rate of inflation, right? Depending upon how we spend money. You know, I don't spend money like the average consumer and go buy a new iPhone every time the damn thing comes out. I'm going to run the phone I've gotten to the ground, right, before I get another one. People who spend money like that experience inflation at its peak, no matter what it is that they're spending money on. We invest differently, we consume differently. Anywhere you look at that, in that gap, even if you go all the way to the Fed's inflation, it's lower, it's higher than the rates are today. So I'll continue to tell everybody, if you're borrowing long-term and the rate of inflation, meaning the dollar is eroding by the value of whatever inflation is, you're never paying back what you borrowed because you're actually getting the money for free. Their interest that they're charging you is less than what your money, the instrument that you're giving it, they're paying it back with, is declining by. So you should not get so damn worried about this. Yes, worry a little bit about inflation, but if you're properly structured and you're getting involved in business properly and you're setting your investments up properly and you're leveraging it properly and you're not being crazy like a consumer and paying down the debt so damn fast that you end up actually giving them more money while it's worth more, you win. So don't stress yourself out about the interest rate. Don't come charging at us looking to try and lock it when we can't target when it's going to close. Any final words, guys? Dave, you got any final words for us?
No, I think we've covered the important stuff. I think you're right that we should be ready for rates to go up, but to keep it in perspective and remember that you know, mortgage money is very cheap, which is what your chart just showed.
100%. Mr. Bear?
I don't know, don't be conscious like you know what the rate is today when you're calling and looking for a quote or something. What we quote you today, and you find something over the weekends and you give us a call on Monday or Tuesday, it's potentially changes. Our rates aren't fixed for like a week at a time. I try to explain, they move day to day and sometimes hour to hour.
There's been times that a minute goes by and it's changed. I mean, Dave knows
Yeah,
that. Like, what are you doing, Dave? What the hell's going on with my rates?
No different, like you said, than fuel prices.
It can change quickly.
But right on. We're here to support you guys. We're here to back you up. We're here to give you the best data we can, and also know we're going to help guide you through the process the best we can. Just know that the one thing that the whole banking world is screaming about, rate, is a way of suckering you into doing what they want you to do. Talk to us. We'll guide you through the thing. You're safe. You're a lot safer than you believe, regardless of what the rates are doing, just because of what inflation is doing. So thanks, guys. We appreciate you taking the time, and we'll talk to you all on, I think, Tuesday. It's Friday, right? So Tuesday. Thank you.